So we've had a big month, including elections, including the markets coming up. So we'll touch a little bit on how we expect the elections to affect the market, how we're already seeing it affect the market, and we'll go through our normal routine. So these are all the topics we'll touch on. Before we move on, what we've seen in the market is certainly tied to the election. Now, I personally think it's tied to the fact that we have a Republican in office, and the policies that are potentially going to be in place. The fact that we have a Republican Congress and a Republican president makes it a much smoother transition, at least for the next 2 years. So the mandate that has been put in place is shaping up to get the changes that Trump had suggested he wanted. That being said, some of the market moves may have happened anyway, as we've been talking about for a while, just based on the uncertainty going away. So you often have, when there's uncertainty on who's going to be in power and what the rules are going to be going forward, oftentimes once that's lifted or made clear, you get a step up. So we had been talking about potentially having the market go up through the end of the year. It now looks very much like that's what we're going to see. It does not at all affect what I think is the ultimate downturn, because the market and the economy are two different things. And so we'll talk a little bit about that. So let's jump into the market. So this is as of Monday. The S&P was at 6,000, and you'll see on this monthly chart, it's up at a very high point. In fact, the highest point in history. That is a good thing for people holding stocks currently. It is just exacerbating the valuation of stocks, however, meaning that they're getting farther and farther out of the norm, and eventually they have to revert back to the mean. And that means coming down significantly. So we'll revisit some of the slides we did last month just to see how they changed. So you'll see the S&P 500 with yield curve inversion. What that means is short-term bonds are paying higher interest rates than long-term. And in this chart, all the red points are where you have that inversion, and you typically have a bear market following that inversion. So we've got the biggest inverted yield curve in history right now. You see that big red line, and it's getting longer. That is a very strong indication that we're going to see the market come down, and that the Fed has painted themselves into a corner a little bit. So we visited the Buffett indicator last time, which is the total US stock market divided by the gross domestic product, or GDP. And on the next slide, the blue line is the Buffett indicator. And you'll see we're at 208 now. The historical trend line is that gray line in the middle. So we have a long way to go down to get back to that trend line. And I do suspect that we will have that happen sometime over the next 12 to 18 months. Okay, so here's our Schiller PE ratio. You may remember we were at 34.77. We're now up to 38.25. The higher that number gets, the more expensive stocks are relative to their normal, which is 16. Um, as you see, we're coming up on passing where we were back in 2022 and potentially catching up to where we were in 2000. And I would not be surprised to see that, especially given what I would call a melt up, which is at the end of a bull market. Oftentimes you have a big run up right at the end before it comes crashing down. And so this looks very similar in a lot of ways to 2000, where we had the tech stocks go way up, and then at the beginning of the year in 2000, they started coming down, and they came down 56%. So I would not be surprised to see a similar result in this scenario. Whether we do or not, stocks are extremely overvalued versus their norm. Okay, so we see the yields have been going up, and you'll see that little zigzag at the end. That's basically caused by the Fed cuts. So we've had two cuts now in what I think will be several cuts in a row. What's interesting is because the market has been so strong, we're seeing yields stay up, which means treasuries stay down in value, which frankly gives you a great opportunity to be buying them at the prices they're at. Because theoretically, they should be more than they are now. And we've talked about the short term opportunity where a lot of times the market comes down and bonds come down with it. Well, right now we've got the market going up and bonds coming down. So there's that opportunity still exists. Same kind of scenario. We did see inflation specifically tied to housing increase more than was expected. So I do think we're going to have a little spike in inflation at least through the end of the year. I do think it's going to take a while for Trump to avoid some of the costs, meaning lowering energy costs and things along those lines. So energy will originally start to come down, and then the cost of shipping and all of those things will come down, and you'll see an effect within your normal spending. Again, that should take a while, so we may see it spike up a little bit more between now and then. But in the same way that the long-term treasuries should perform well as interest rates come down, so should the tips. You should see them go up in value with the added piece tied to inflation. So if inflation goes up, that will also make the tips go up. So I've been getting the question a lot about why I think specifically Elon Musk and Vivek will be able to make a difference in what they're doing. And this is kind of a demonstration of what that looks like. So the base on this is what we would call the problem. And historically, if you're the government, you identify a problem. So let's say the problem is, I'll use California, for example. Let's say the problem is you've got fast food workers that aren't making a living wage. And so you create a minimum wage, and now they're making more, but that creates the next issue. So Now that they're making more, the company that has hired them now needs to pay more, so they have higher expenses. They're not going to eat those expenses. What they're going to do is raise their prices. And so now the prices of everything goes up. And rather than go back to the original problem, which is the folks not making enough, the government goes, okay, we now have a problem on top of a problem. We need to fix that one. And they'll add another layer and they'll raise the minimum wage again, which again raises cost, which just exacerbates the problem. So the original problem being the person who wasn't making enough is still not making enough. The employer is paying way more in expenses and taxes, and the employee is paying way more in taxes. So who's the winner in this scenario? The government. They've increased their revenue, but the other two parties involved in this did not. They're actually in a worse situation, or at least a neutral situation. So this is how government typically works. They identify a problem, they create a fix, and then they need to create a fix for the fix rather than going back to the original problem. So we have Elon Musk, Vivek Ramaswamy coming in with the Department of Government Efficiency. And what they're looking at is where are areas where we can cut certain regulations, certain positions, and reduce the overall cost of government. So again, I do think that's ultimately going to reduce the cost of everything over time, but it's not going to be an immediate fix. Okay, so the Fed, we still believe they're going to be cutting interest rates. So I anticipate that's going to be going forward at least for a few more meetings. Gold. So this is an interesting one. Again, because the market has shot up, we saw gold at a peak right before the election. Once the election was decided, we've seen it come back down. It's still at very high prices versus where it was a year ago. And again, I do anticipate that it's going to continue to go up. So ultimately, what I see happening is the market starting, it'll peak and then start to come down. And at some point on that downward, gold will separate itself and start going up. So they'll be diverging from each other at some point. And so I do believe gold is still a good place to be. Same with the next chart. Silver, same deal. It spiked up to about 35 and is down to about 31 now. Of the two, silver certainly has more to gain than gold, but gold is, for lack of a better term, the gold standard. So a lot of people prefer to have gold over silver. Silver is actually more rare than gold and has more use than gold in manufacturing. So it theoretically should go up considerably over the next 12 to 18 months. So this gives us another opportunity to buy in a little bit lower. One of the things that we might want to discuss on an individual basis is getting into some of the gold and silver miners at reasonable prices right now. So we can discuss that in the future. So the big takeaway from all of that is I do anticipate the market's going to continue to go up. potentially through the end of the year. However, it is going to start coming down at some point, and it's a question of what side of that equation do you want to be on? Do you want to be getting out before it drops, or do you want to get out after it starts to drop? My philosophy is get out before it drops and then have funds available when it does drop to be able to buy stocks at discounted prices. Okay, let's do the disclosures.